Flip on Netflix, thousands of shows appear instantly for about $15 a month, and profit seems to print itself while you do nothing but scroll. Now the real number. In April 2022, a subscriber miss of just 200,000 people, a tenth of 1% of Netflix's user base at the time, wiped $54.4 billion off the company's market value in a single trading day. Here is what this actually costs. Start with what it actually takes to field a credible competitor, not a niche also-ran. In 2024, Disney's combined streaming operation, Disney+, Hulu, and ESPN Plus, committed $8.6 billion to content. Warner Bros. Discovery spent $6.4 billion across Max and Discovery+. NBC Universal's Peacock spent $5.2 billion, and Paramount Plus spent $4.4 billion. These are companies with decades of existing film and TV libraries, deep-pocketed parent companies, and years of head start on content production, and every one of them still trails Netflix's own $15.3 billion content spend that same year. Layer on global delivery infrastructure comparable to Netflix's own Open Connect network, localization into dozens of languages, payment and tax compliance across the 190-plus countries Netflix operates in, and a marketing budget large enough to be noticed against an incumbent that already spent $2.66 billion on marketing in a single year. A realistic year-one commitment for a genuinely competitive entrant clears $5 billion before a single subscriber has signed up, and that only buys a seat at the table, not the lead. Content is the dominant line, and it isn't optional or flexible. Netflix spent roughly $17.5 billion on content in 2024 and is guiding toward $20 billion for 2026, funding more than 700 original series, films, and documentaries a year across 50-plus languages. Marketing ran $2.66 billion in 2023, spent largely to keep churn low in an increasingly crowded market. Technology and delivery infrastructure, payment processing fees that can run up to 30% on in-app purchases through mobile app stores, and general administrative overhead stack on top. Netflix's own reported cost of revenues, content amortization and delivery combined, was $19.72 billion in 2023 alone, up from $19.17 billion the year before, a steady upward march that tracks the growth of the content budget itself. Add marketing and technology and development spending together, and Netflix's full 2024 operating expense base totals roughly $28.6 billion, calculated directly from its $39 billion in revenue against $10.4 billion in operating income. Every dollar of that is committed before a single subscription renews, regardless of whether that quarter's slate of new releases lands with audiences or not. Now the money side. Netflix closed 2025 with 325 million paid subscribers and $45.2 billion in revenue, at a blended global average of roughly $11.70 to $13 per subscriber per month. Against the cost stack in Section 2, that produces a genuinely strong 29.5% operating margin, healthy by any industry's standard, and Netflix itself is guiding toward 31.5% in 2026. But that blended number hides something the headline doesn't show. North American subscribers generate roughly $17.28 a month in revenue. Asia-Pacific subscribers generate about 7.72 cents, less than half. Nearly all of Netflix's newest subscriber growth is coming from the low side of that gap, which means each new subscriber added today typically contributes a fraction of the profit that an existing North American subscriber does. Even while the top-line growth number keeps looking strong on a headline slide investors see every quarter. The market doesn't grade Netflix on that healthy blended average. It grades Netflix on the growth rate, and that number has already proven to be far more fragile than the underlying business. The external variable is subscriber growth expectations, and the market's tolerance for a miss is razor thin. In the first quarter of 2022, Netflix lost 200,000 subscribers, its first subscriber decline in over a decade, and told investors it expected to lose 2 million more the following quarter. The stock fell 35.1% in a single trading session on April 20, 2022, erasing $54.4 billion in market capitalization overnight, the largest one-day drop in the company's history at the time. Shares had already shed 65% of their value over the prior 6 months. The trigger wasn't a collapse in the underlying business. Full-year 2022 revenue still grew to $31.6 billion. It was a growth deceleration, meeting a market that had priced Netflix as a company that simply didn't slow down. Netflix went on to lose 970,000 more subscribers in Q2 2022 before recovering, driven in large part by the release of a single hit season of television. A number that's small, relative to a subscriber base of over 220 million at the time, was enough to reprice the entire company by tens of billions of dollars within hours of the earnings call ending. To understand what Netflix's economics actually beat, look at the company that turned down the chance to buy Netflix outright for less money than Netflix now spends on content in a single day. In 2000, Netflix co-founders Reed Hastings and Mark Randolph offered to sell their company to Blockbuster for $50 million. Netflix had roughly 300,000 subscribers at the time and wasn't yet profitable. Blockbuster's CEO turned the offer down, viewing Netflix as a niche mail-order service, posing no real threat to in-store rental traffic that generated most of Blockbuster's revenue. At its own peak in 2004, Blockbuster operated more than 9,000 stores in 25 countries, employed roughly 84,300 people, and generated close to $6 billion in annual revenue, a genuinely enormous, dominant business by any measure of the time. Late fees alone generated an estimated $800 million a year at peak, 16% of total revenue, and a business line customers actively resented every time they paid it. That same year, Viacom spun Blockbuster off as an independent company, loading it with $905 million in debt through a special dividend, just as DVD by mail and eventually streaming began eroding the core in-store model that had built the company. By 2010, late fee revenue had collapsed to just $134 million, an 83% decline with no replacement revenue stream built to take its place in time. Blockbuster filed for Chapter 11 bankruptcy in September 2010, carrying roughly $900 million in debt, and its last company-owned stores closed within a few years after that filing. This was not simply a failure to see Netflix coming. Blockbuster's entire profit engine, late fees, was structurally incompatible with the frictionless, subscription-based model the market was moving toward, and the debt loaded onto the company in 2004 removed any real capacity to fund a pivot once the shift accelerated. Here's a cost that never shows up in a press release about a hit show. Content amortization write-downs on titles that generated real buzz but not real retention. Netflix capitalizes production costs and amortizes the large majority of a title's cost within its first year of release, based on expected viewership. Picture a big-budget series that debuts strong, lands in the global top 10 for a couple of weeks, and generates plenty of headlines, every visible signal of a hit. If that same title doesn't drive meaningful subscriber retention past its opening weeks, its production cost still gets written down against that year's content expense almost in full, regardless of the buzz it generated. Netflix doesn't disclose title-level profit and loss publicly, so a show that looked like a win in the cultural conversation, generating memes and social media chatter for a week or two, can quietly be a complete write-off buried inside a single quarter's content amortization line, with no headline ever attached to the loss and no way for an outside investor to trace it back to any specific title. There's another cost growing faster than any other line item in this business, and it isn't on Netflix's balance sheet at all. It's sitting inside the labor contracts that determine whether new content gets made. That risk is industry-wide labor disruption to the content supply chain, and it doesn't have to originate inside Netflix at all to hit its retention numbers directly. The 2023 Writers Guild and SAG-AFTRA strikes shut down U.S. film and television production for months, and as a direct result, Netflix released roughly 130 fewer original programs in 2023 than it had in 2022. The new contracts that ended those strikes also introduced ongoing streaming residual and AI use provisions that add real, escalating per-title cost going forward, on top of whatever content Netflix commissions next, permanently raising the baseline cost of producing the same volume of content it produced before. Netflix survived the 2023 disruption because its content library was deep enough and its release cadence global enough to absorb a thinner U.S. release slate for a year without a mass subscriber exodus. A longer or broader industry-wide production stoppage, hitting at a moment when the content pipeline is already thinner than usual, is exactly the kind of single event that could cut into the steady stream of new releases the entire retention model depends on. And retention, not any single title's success, is what the subscription business is actually selling every month. Scale is mostly an advantage here. A $17.5 billion to $20 billion annual content budget buys negotiating leverage no traditional studio can match, and Netflix's own global delivery network spreads its fixed infrastructure cost across 325 million subscribers, driving delivery cost per stream down as volume grows. But scale also means Netflix's remaining growth increasingly comes from exactly the lower margin markets described in Section 3, diluting the blended economics even as the subscriber count keeps climbing. Operating in 190-plus countries also means managing that many separate regulatory, tax, and content rating regimes simultaneously, plus local competitors with home market advantages Netflix can't fully replicate. At a certain size, Netflix isn't really one streaming business anymore. It's simultaneously a global content studio, a live sports broadcaster following its 10-year WWE deal, a video game publisher with dozens of titles in its catalog, and a growing ad sales network, all bundled under one subscription price with very different margin structures underneath, most of which the average subscriber never sees or thinks about. Optimistic. Revenue grows roughly 15% from 2025's $45.2 billion to about $52 billion in 2026. Content spend rises to $20 billion as guided, and the operating margin expands to Netflix's own stated 31.5% target. Operating income, approximately $16.4 billion, continuing the multi-year trend of margin expansion alongside growth. Realistic. Same $52 billion revenue year. One flagship series, budgeted at roughly $200 million, debuts to strong buzz but weak retention, forcing an effective write-down of most of that spend within a single quarter, with nothing to show for it in subscriber growth or renewal rates. A major Latin American currency devalues sharply against the dollar, echoing real FX headwinds Netflix has already disclosed in Brazil and Mexico, cutting reported regional revenue by an estimated $400 million in dollar terms, even though local subscriber counts don't move at all. A single quarter's subscriber growth lands modestly below Wall Street guidance, echoing the pattern from April 2022 almost exactly. Recalculate. Full-year operating income drops by perhaps $550 million from the optimistic case, a real, but entirely survivable hit to a company generating tens of billions in operating income. Yet the stock market's reaction to that same soft quarter, based directly on the 2022 precedent, can erase tens of billions of dollars in market value overnight, an order of magnitude more than the actual line-item damage to the underlying business. The difference between those two scenarios is one content bet, one currency swing, and one soft quarter of guidance. None of these are exotic disasters. All three happen to someone in this industry every year, and at Netflix's scale, the market's reaction to any one of them is worth far more than the line item itself. Nearly every major standalone streaming service launched to compete with Netflix has spent years posting losses before approaching break-even, and Quibi, a short-form streaming service backed by Disney, NBC Universal, and Warner Media, that raised $1.75 billion from some of the most sophisticated media investors in the world, shut down entirely just 6 months after its April 2020 launch, burning through roughly $1.4 billion in that span alone. The documented cause across the industry was never a shortage of creative talent or content ideas. Every one of these companies could hire great writers and directors. It was structural, content budgets that couldn't match Netflix's scale over a sustained multi-year period, and in Quibi's case, a total absence of any existing subscription base large enough to spread that spend across from day one. 5 habits separate the operators still standing from the ones that burned out. They cancel underperforming titles quickly rather than chasing sunk production costs, limiting how much of the content budget gets trapped in shows nobody's watching. They price differentiated ad-supported and ad-free tiers to capture price-sensitive subscribers without cutting into full-price revenue. They build owned global delivery infrastructure rather than renting third-party capacity at scale, keeping the cost per stream low as viewership grows. They diversify revenue into advertising, gaming, or live events early, rather than only after subscriber growth stalls and the pressure to diversify becomes urgent. And they set explicit, disciplined margin targets rather than pursuing open-ended growth at any cost spending with no stated profitability deadline attached to it. The $50 million Blockbuster once turned down to own Netflix outright, back when it was still an unprofitable mail-order DVD company, is now less than what Netflix spends on content in a single day of its $20 billion 2026 budget. But a single quiet quarter of slower-than-expected growth can still erase tens of billions of dollars in value overnight, exactly as it did in April 2022, on a business whose actual operating income barely moved. Netflix isn't really selling movies and shows. It's selling a growth rate, And the day that rate stalls is the day the entire model gets repriced by a market that never fully forgot what happened in 2022. Subscribe for the next breakdown in this series.